Today is the 7th of August 2023. My name is David Hickson, and in today's market update we're going to be taking a look at the S&P 500. This is a follow-on to last week's market update video. We're going to be taking it a little more detail, and in particular we're going to be speaking about the subject of certainty. Many people, when they first start working with a Hurst cycles approach to financial markets, are seeking certainty. In other words, they want to perform an analysis that they are absolutely certain is correct. In my opinion, certainty is an elusive quality when it comes to performing a Hurst cycles analysis. There are times when we have a great deal of confidence in our analysis, and there are times when we have less confidence, but achieving absolute certainty in the correctness of the analysis is a fairly rare thing. The great benefit, however, about taking a Hurst cycles approach to trading the markets is that despite the fact that we are not able to achieve certainty, we are able to make very confident trading decisions. That is a fairly unique aspect of the Hurst cycles approach because of the way in which the cycles influence financial markets and because of the structure of the nominal model that we work with. And that is what we're going to be taking a look at in today's video. So let's start with a very quick recap of what I was looking at in last week's video. This is the analysis that places a 9-year cycle trough in December of 2018. And if you haven't been keeping up to date with these market updates, I would suggest that you go back and take a look at recent market updates involving the S&P 500 to understand why that trough is positioned there. That, of course, implies that the trough that we experienced in October of last year is therefore a 54-month cycle trough. And what has happened since then is that, of course, the market has been bouncing out of that 54-month cycle trough. The next important trough is likely to be the 18-month cycle trough, expected only next year. Let's zoom in and take a look at a little more detail. Here is the daily chart, and there is that October trough last year. And in last week's market update video, I was discussing the possibility, perhaps it's even a probability, that the 40-week cycle trough occurred over here in early July. You will notice these pin symbols. They tell us that I have influenced this analysis to position these troughs over here. So to get back to the subject of certainty, am I certain this is the correct analysis? No, I'm not certain, but I am fairly confident that it is. However, something happened last week which bears attention, and so that is what we're going to be looking at now. In last week's video, I discussed this 40-week cycle trough and presented my reasons for positioning the 40-week cycle trough over there. I also displayed various FLDs. Here are 3 of them: the FLD for the 20-day cycle, the 40-day cycle, and also the 80-day cycle. I also presented the 18-month cycle FLD, which generated a target, as I presented in last week's video, of 4,600. That target was, of course, reached about 10 days ago, and there is price breaking up above that target and then immediately falling down again. It, of course, tried again last week and poked its head just up above 4,600, I think I'm correct in saying, and then it turned down again. I mentioned in last week's video that the fact that the 18-month cycle target has been achieved does not necessarily mean that the market is going to immediately turn down again. But turn down it has. Is it possible that that is the peak? Yes, it is possible. So how then does this work with the 40-week cycle trough over here, and then a peak occurring so soon after that trough? And is it possible that the 40-week cycle trough should not be positioned there? One of the reasons why Sentient Trader by default displays those pin symbols when you open a chart in the software is to remind you of the fact that you have influenced this analysis, and that in fact there could be some mistakes in that analysis. So let's take a look at what happened last week and discuss the implications of that. First of all, here is the 20-day FLD, which I spoke about last week, where price found support at the level of the FLD at the same time that the 20-day cycle trough formed. The next interaction between price and the 20-day FLD would, of course, be a cross down below that FLD, which did occur on Wednesday. That we would label a D category interaction as price comes down into the 40-day cycle trough, which we are expecting over here. There you can see the nest of lows. We are expecting that trough to form towards the end of this week. So far so good, no anomalies. However, on Wednesday, as you can see, price came down to the 40-day FLD. Now, as I mentioned in last week's video, when price comes down to the 40-day FLD, we would expect, following a 40-week cycle trough forming in the market, that the 40-day cycle FLD will provide support to price, just as the 20-day FLD did at about the time of the 20-day cycle trough. And so the 40-day cycle FLD is expected to provide support at about the time of the 40-day cycle trough. You can see that on Wednesday, price came down to that 40-day cycle FLD, and it looked as if though the FLD might provide support. On Thursday, price still tracked along the FLD. In other words, the high price was above the FLD and the low price was below the FLD, and it was being provided with approximate support. However, it did drop a little far below that FLD. On Friday, price again tracked along the FLD. In other words, the high price was above the FLD and the low price was below it. But there was some bearish action indicating that it seemed that the FLD was not really providing support. Of course, we have no data for price action over the weekend. It is an important aspect of Hurst's approach that the cycles influence financial markets 24 hours a day, 7 days a week. And if you don't understand that concept, I would encourage you to download the 10 core concepts document that you'll find a link to in the description below this video. So here we are on Monday, and price is now fairly far below the 40-day cycle FLD. It looks as if though support has failed. Of course, it is not too late for price to bounce up again and to continue tracking along the FLD and then bounce upwards. But price is certainly fairly far below the FLD, and so we need to ask ourselves, are we confident in this analysis? Or is it possible that a major peak has formed and that price is going to keep moving down? First of all, let's discuss my confidence in this 40-week cycle trough. I presented many of the reasons in last week's update, and I'm not going to repeat them, so I would encourage you to take a look at that. Let me point out a few other things here. First of all, if a major cycle trough formed, a 54-month cycle trough in October of last year, which, as I've mentioned several times, is what I believe occurred, then we would expect cycles to run shorter. In other words, the troughs would occur early. Because of the rule of thumb declared by Hurst, whereby troughs tend to occur early when the underlying trend is bullish, and peaks tend to occur late when the underlying trend is bullish. And so we clearly have an underlying trend that is bullish, both by virtue of the fact that we believe this was a 54-month cycle trough over here, and because of the fact that clearly the bull has been strong in this market. And so therefore we probably have a bullish underlying trend. Under those conditions, we would expect troughs to occur early. And so if we measure the number of bars, which of course we are doing with a bar count there, but if I measure them up to this 40-week cycle trough here, you can see that 269 days elapsed. The average length of a 40-week cycle discovered by Hurst 50 years ago was 272 days. And so that is a 3-day early cycle trough. What if that 40-week cycle trough has not yet occurred? It would not be very late at 298 days, or perhaps it even occurred on Friday, 294 days, or perhaps it still lies ahead of us, which means it could be 300 days or more long. So that is not very long. But the rule of thumb involving underlying trend and early troughs leads me to believe that it is more likely that the 40-week cycle trough has occurred. I presented other reasons for that 40-week cycle trough to have occurred, including interactions with the 20-day FLD in last week's video, so I would encourage you to go back and take a look at that. If we zoom in and take a look at this 20-week cycle, is there any clear evidence in the analysis in this 20 weeks from the middle of March to the middle of July that raise my confidence? The truth is, there isn't really. During this period of time, we are not seeing clear M shapes forming in this market at all. I can draw an approximate M shape, but what about this 80-day cycle trough? Did it really occur over there? or would it be better placed over here, which would imply that the 40-week cycle trough should occur later? And so to get back to the question of certainty, I'm not certain about this analysis. I do have a high confidence in it, but there is the possibility that the 40-week cycle trough should not actually be pinned over there, but should occur later. So where might that 40-week cycle trough occur if it did not happen in the middle of July? Here is a quick trick that I have learnt over the years. If you have doubt around the position of a fairly major trough, then the most likely position for that trough to have occurred if it did not occur where I have positioned it in the middle of July is very simply at the next cycle trough that you see a clean nest of lows for in the future. In other words, this 40-day cycle trough that we have been anticipating might turn out, if price continues to move downwards, to be a better position for that 40-week cycle trough. That's just a rule of thumb. Let me be a little more mathematical about it and describe another approach that some analysts use. I mentioned in last week's video that the 20-week cycle that elapsed from October to the middle of March was a long one at 151 days. I also mentioned very quickly in passing that there are two approaches to the way in which these cycles achieve their average wavelengths. One approach is that following a long cycle wavelength, we would expect the next 20-week cycle to be a short wavelength, and that is what would have been achieved if the trough of the 40-week cycle occurred in the middle of July with 119 days. The average length of a 20-week cycle is, of course, 136 days. And so in this example, or with this analysis, we have a long 20-week cycle followed by a short 20-week cycle. But there is another approach, which is to suggest that because the 20-week cycle is currently running long, in other words 151 days, we would expect it to keep running long. In other words, the next iteration of this 20-week cycle is likely to be the same length, 151 days. Do you notice something interesting that occurs if I move my bar counter to 151 days? It is directly above where we are expecting that 40-day cycle trough to occur at the end of this week. And so if we are going to experience two 151 20-week cycle wavelengths, then the 40-week cycle trough will occur where the 40-day cycle trough is expected at the moment, according to this analysis. So, in terms of questioning my certainty about this analysis, we have now discussed the possibility that the 40-week cycle trough does not lie behind us, but does lie ahead of us. Let's take a look at that analysis in a separate chart. You can see that we have the same 20-week cycle trough over here in the middle of March, and here is the nest of lows for the 40-week cycle trough. It is a very straggly nest of lows, not really a great nest of lows, but it does of course highlight the point that the 40-week cycle trough is expected round about now, or perhaps this week. Let's zoom in and take a look at our FLDs on this analysis so that I can get to the point of today's video, which is that the Hurst cycles approach is a robust one and that we can make sensible trading decisions even when we have uncertainty in our analysis. Here are the 20-day and the 40-day FLDs on this alternate analysis. You will notice if you look carefully, and we'll take a look at the FLDs in this zoom scale in a moment on the other analysis, you will notice that the FLDs are very similarly positioned. They are in fact only displaced by 1 day. Why does an FLD have a different position on a chart with a different analysis? Because the FLD is displaced into the future on the basis of the recent average wavelength of a particular cycle as calculated from the analysis. And so if the analysis is different, the FLD might be in a different position. I say might be because often different analyses result in the same recent average for each one of the cycles. And that is the case over here. Although this FLD has been slightly displaced, it is only 1 bar different from the other analysis, we have effectively the same crossing points. So let's work out a target for price crossing down below the 40-day FLD on this analysis. The crossing point is over here, and the target that is generated is at a level of 44.25, which is about over here. And you will notice that if I display the 80-day FLD, That target is at about the level of the 80-day FLD. Is it possible that this trough in this analysis is therefore going to form at the level of the 80-day FLD? It is absolutely possible. We would expect the 40-week cycle trough to occur at the level of the 40-week FLD, but that is way below us. And as I mentioned in last week's video, I think it is unlikely that price is going to come all the way down to the 40-week FLD because of the bullishness in the market. Why is the market so bullish? Because of that high magnitude cycle trough in October of last year. And so now let's bring this to a conclusion and discuss the trading decisions that we could make despite our lack of complete certainty in this analysis. First of all, it's very important to bear in mind when you are making trading decisions that your trading decisions are based upon your time frame. What sort of time frame are you looking at trading? If you are a fairly long-term trader, you would still be riding the bull market out of the October trough. If you are a much shorter-term trader and you would have wanted to benefit from the move down to the 40-day cycle trough, you would not be long. You might be short to catch the move down to the 40-day cycle trough. However, given the recent bullishness, it might be unlikely that you would have actually taken a short position, depending, of course, upon your time frame. If you are an intraday trader or a day trader, then you almost certainly would have been short during these downward moves as price comes down into this trough. The only question really is, what trough is it? According to this analysis, we are looking at price coming down into the 40-week cycle trough. We have a target over here. If you are short to catch this move, you would want to stay short until you see evidence that this trough has formed in the market. Now let's switch to the other analysis and consider how our trading decisions would differ on that analysis. Here are those FLDs. And as I mentioned, the crossing point for the 40-day cycle FLD is at almost exactly the same level, and so we have the same target over here of 44.25. There is the 80-day cycle FLD that is a little more displaced because of the different average wavelength of the 80-day cycle in this analysis. However, our expectation at the moment is pretty much the same. We are looking at price coming down into a trough towards the end of this week. It is only a 40-day cycle trough. We have the same target for the price move down into that trough. Again, whether we are considering entering a long trade or a short trade would depend very much on our time frame. But according to this analysis, we would be tracking the short trade down into the 40-day cycle trough, and then expecting a bounce out of that 40-day cycle trough, which could provide the opportunity for a good long trade. So let's set aside for the moment any consideration of what current position you might be in, whether you are short or long. Let's consider the opportunity coming up this week. In the other analysis, we are expecting price to bounce out of a 40-week cycle trough. We have a big magnitude cycle trough in October of last year. We have seen a bullish market. We therefore have a potential long trading opportunity. What about this analysis? Well, we have a 40-week cycle trough according to this analysis that occurred only about a month ago. We are looking at price forming a 40-day cycle trough. Again, we have a long trading opportunity. Our FLDs are in almost exactly the same position. I'm speaking about the 20-day and the 40-day FLDs. And so again, we do have a long trading opportunity. The only reason why the 40-day cycle trough might not provide us with a very good long trading opportunity in this analysis is by virtue of the fact that price has dropped down below this FLD, indicating some bearishness in the market. If price continues down, exceeds this target and goes below it, we will not be so enthusiastic about our long trade because we are seeing signs of bearishness. But if those bearish signs don't appear, we will be looking at the same long trading opportunity according to this analysis. And so, despite our lack of absolute certainty in this analysis, despite our varying levels of confidence in the different analyses, we are looking at very similar trading decisions. When different analyses provide similar trading decisions, your confidence in those decisions increases. I do hope you found this market update useful and interesting. If you have any questions, please put them in the comments below the video or join us on our Discord server. I look forward to hearing from you.